Putting together a statement. WIO should be able to delegate financial statement preparation to an employee, your bookkeeper, or an accountant. But before you can supervise the bookkeeper, you need a working knowledge of statement procedures. You should even be able to prepare the statements yourself. If you're aware of the whole operation, you have a better chance to turn that financial data into added profits. This chapter takes you through the steps of preparing a statement, from account coding, posting accounts and test balancing, making the trial balance and closing adjustments, to drawing up the statement itself. Account coding. The most common headache for builders and their bookkeepers is coding accounts properly. The usual problems are poor definitions and inconsistency. That leaves the chart of accounts open to interpretation by each person who uses it. For example, the purchase of business cards could be assigned to office supplies, printing, sales promotion, or advertising. Each employee who handles coding may have a different idea about where to assign this and other items. Within a year, similar or identical expenses could end up in several different accounts. Your financial statements would contain inconsistent and misleading details because the general ledger hadn't been properly maintained. If you suspect that your coding has been inconsistent, go back through the accounts for several months and analyze the treatment of various expenses. Unless you search for them, account coding mistakes are usually only discovered under two circumstances. First, when accounts are obviously incorrect. Second, when actual expenses are significantly higher than budgeted expenses. One benefit of a good expense budget is that you're alerted whenever the actual costs vary too far from budgeted amounts. Then you can perform an analysis to find out why. Once you discover an inconsistency, first adjust the account assignment, then prevent future coding errors by tightening up and refining your account definitions. Make up a chart of accounts with a written description of each account category and what types of items it includes. You or your bookkeeper can then refer to the definitions whenever you code items. See Appendix A for a complete chart of accounts for the general ledger. The general ledger? The general ledger is nothing more than a summary of your business activities. Every asset, liability, net worth, income, cost, and expense account is listed here. Some types of accounts, such as expenses, can be combined into one large account. Then you can keep a sub-account for each expense under the main heading as a ledger account control. This saves space and posting time. The real details in the specialized journals: sales journal, check register, payroll, accounts receivable, payable records, and the like. Keep the general ledger as concise as possible, with as few divisions as necessary to prepare a good financial statement. The general ledger isn't the place for large control listings. And don't use it to support in detail the figures on a financial statement. A brief general ledger is easier to control and produces statements more easily than a bulky ledger that's full of detail and hard to balance. Remember the following points when you make entries in the general ledger. Keep the general ledger in balance. Keep the general ledger in a summary format. Don't let it become too detailed. And trust the general ledger only to employees who are competent to work in it. Refer to the general ledger for spot checking and quick reference. Develop a full understanding of the workings of the general ledger. Leave a good audit trail. This means that whoever reviews your statement should be able to trace all your account entries back to the original document, which supports the final entry itself. An audit trail might start with an entry on a financial statement referring to a specific account in the general ledger. The entry in the general ledger account should, in turn, refer back to an entry in the check register, the receipt journal, the payroll journal, or the general journal. The general ledger may refer to any of these entries with a code. For example, the check register may be called CD, and the check register page may be identified as 01 to 06, as explained later. From any of these entries, you should be able to trace back to a canceled check, a duplicate bank deposit slip, or a full explanation of the entry. The check register, for instance, lists the check number and vendor. The paid bills file should contain in alphabetical order a copy of the check request, a voucher document, or a carbon copy of the check, along with the paid bill itself. Income account entries are further supported in the accounts receivable system. Payroll entries are traced back to the payroll summary and time cards. Special journal entries can be traced back to well-documented worksheets. The figures on the statement are thus verified all the way back to the original document. The audit trail is complete when you can do this for every account on the entire financial statement. General ledger posting. The general ledger is broken down into the following main categories: assets, liabilities, and net worth, income, direct costs, general expenses. Income, general expense categories. For example, some general ledgers distinguish between selling expenses and direct overhead, or carry additional sections for other income and other expenses. Use index tabs, as in Figure 24%-1, to make access to your general ledger more convenient. Figure 24-2 shows a typical general ledger account page. The Figure 24-1 use index tabs in the general ledger. Standard procedure for posting the general ledger is to cross-reference each item with a check mark. Each ledger page also includes a posting reference. As you post each entry from the source document to the general ledger, place a check mark in the source document. Thus, you know that all entries from that document have been made to the ledger. At the same time, the general ledger shows a reference back to the source document in a column labeled Posting Reference. The following posting references are similar to those in common use: ACR 0107, ACD 0104, J42. When you have double-checked the math in the general ledger, place a check in the check mark column to verify that, through a given point, the math accuracy has been proven and the general ledger is balanced. In Figure 24%-2, space has been provided on the page for the date, a description of the entry, and the activity and balance of the account. Each page should be identified with the name, code, and page reference, which identifies the page number within each account, and therefore the page number in the ledger. Show the year on each ledger page as shown below. The check mark in this case means same as above, to indicate another entry on the same date. The general ledger is a perpetual record. Pages are not replaced each year, but are added instead. So identification by year is as important as by month. The description column, often left blank, can be used for special notations and reminders pertinent to the account. It's a good idea in some accounts to identify the item in detail so that reversing or similar entries are made in the correct account. The balance of an account plus the debits less the credits produces a new balance. In a credit balance account, the negative balance forward will be decreased by debits and increased by credits. The double entry system was designed to assure that all entries are made correctly. If they aren't, the general ledger will be out of balance. Of course, if Figure 24-2 ledger page, an entry is correctly entered, but in the wrong account, the general ledger will balance, but it still won't be correct. Only a careful procedure minimizes this problem, and you should be able to catch these mistakes by carefully reviewing your trial balance. Anytime the general ledger is out of balance, you have to find the error. The first step is to check the source documents. These should be up to date and in balance. On the check register, the sum of all distributions is equal to the reduction of cash. On the receipts journal, the sum of all sales is equal to the accounts receivable total. All cash actually received is equal to the increase in cash. By the same rule, journals must be equal in debits and credits. Post the entries from the journals and source documents to the general ledger once you determine that they're all in balance. Many errors can occur in the posting procedure itself. Here are some of the common posting errors. Transposition two numerals within a number are reversed. For example, 2,146 is recorded as 2,416 will always add up to 9 or a multiple of 9. In the example, the difference this error creates is 270. 2 plus 7 is 9. A decimal misplacement, a number is recorded with the decimal in the wrong place. For example, 2,146 is recorded as 21.46, which is difficult to find without examining every account. But you have a clue about what to look for. This is similar to a transposition. In this case, you'd be out of balance by 2,124.54. The digits total 18, and that suggests a transposition. Next, subtract 54 from 100 and look for the answer in the cents column. If you don't find it there, look in the tens column of whole dollar amounts. A debit, credit error, a debit is entered in the credit column, or vice versa. The amount out of balance will be an even number because this error doubles up the amount of the misplaced entry. To find such errors, divide the out of balance amount by 2 and search for an entry of that amount. A simple math error, an error is made in adding the new balance in the general ledger or in totaling one of the source documents. The only way to find this is to double check your arithmetic. Keeping books in balance isn't always easy. Errors have a way of hiding so well that sometimes only a painful and time-consuming search will find them. But every accounting document can be balanced. Inexperienced bookkeepers often blame the system rather than their own lack of accuracy. If you have an employee who's having problems balancing the books, the best solution is patience and understanding. A motivated bookkeeper will learn quickly from his or her mistakes. The trial balance. The next step after posting the general ledger is to test the balance. Because all entries in the double entry method consist of equal debits and credits, the sum of all accounts in the correctly maintained general ledger will equal 0. To test the balance, run a tape of the ending balance for each account in the entire ledger. If the tape does not come out to 0, find and correct all the errors. A second tape should prove the balance by equaling 0. Then prepare a trial balance as explained in Chapter 21. The first two columns of Figure 24-3 are a trial balance from the general ledger before adjustments. First, isolate the balance sheet accounts on the top part of the trial balance to get a year-to-date profit or loss total. Total assets less all liabilities and net worth produce a difference. This difference between the total of liabilities and net worth, when subtracted from assets, should represent profit. Secondly, isolate the income, cost, expense accounts in the lower part of the trial balance. The difference between the debits and credits in this part of the trial balance should be the same as the profit or loss from the top part. That's because general ledger entries often consist of a debit to an asset account and a credit to an income account, or a debit to an expense account and a credit to an asset account. So many entries are split with either the debit or the credit going to the asset, liability, net worth side, and the other entry to the income side of the general ledger. Neither part will balance alone, but in a balanced ledger, the differences will be the same in both parts. Adjusting the trial balance. Account balances must be adjusted when you prepare financial statements. Record these adjustments only on a worksheet to produce interim statements during the year. But at the close of the year, make the adjustment entries in the general ledger itself as well. The second two columns of figures in the worksheet, in Figure 24-3, show the adjustments to the trial balance accounts in the first two columns. The following is an explanation of these adjustments. Inventory adjustments. The year-end inventory, $1,600, is reversed out and replaced by the current inventory amount, $1,900. These adjustments are offset in the materials purchase cost account. Depreciation. The accumulated depreciation fixed asset account is increased by a credit of $440.06. The offsetting debit is to the expense account, depreciation, trial balance, and closing adjustments. For the 2-month period ended February 28, 20, closing. Figure 24-3 trial balance is reversed. The $1,211.60, even though the amount is still listed in the general ledger. Actual booking of such entries is often made only once a year. This reversal is replaced by the current accounts payable, $318.45. In this example, both past and current accounts payable are for materials, so the appropriate offsetting entries have been made to the materials purchased account in the expense portion of the adjustments. No other adjustments are listed in this example. In a real situation, there may be numerous other adjusting entries such as coding corrections or bank reconciliation items. Notice that the debits and credits of the adjusting entries are equal, as they should be, because the entries are split between the balance sheet accounts and the income accounts. The adjustment to increase income from adjustment entries is $753.09. The final two columns represent the adjusted trial balance. In this example, the true current status of McDonald Construction. Accurate financial statements can now be prepared from this adjusted trial balance. Document all adjustment entries with notes to show why you made the adjustments. For example, list the vendors and amounts purchased when making up the accounts payable adjustments. Specify what accounting method you used to arrive at the adjusted inventory total. A balance sheet. Figure 24-4 shows the balance sheet for McDonald Construction. The sheet has been prepared from the adjusted trial balance and shows balances as of February 28. All the pertinent. Balance sheet February 28, 20%. Information is available in a format for analysis. The current ratio is more than the 2-to-1 minimum standard, as can be seen at a glance from the total current assets and the total current liabilities entries. All other ratios prepared from balance sheet information can be calculated quickly and efficiently from the figures given. The information presented in the balance sheet can be traced back through the trial balance to the unadjusted totals from the general ledger, to the original entry documents, and back still further to the Figure 24-4 balance sheet. Duplicate deposit slips, canceled checks, and paid invoices that prove the numbers. An income statement. The income statement for McDonald Construction is shown in Figure 24-5. Here again, all details are available for instant ratio analysis. Net profit is about 20% of gross sales, while gross profit is slightly less than 50% of gross sales. McDonald should compare these figures to last month's and last year's to check the trend of his profits. The change in inventories represents a $300 adjustment to the cost of goods sold. Both the beginning inventory and the ending inventory are shown in order to establish the method by which direct costs were computed. Showing both inventories is convenient because it allows McDonald to see what his average inventory was during the period of the financial statement. Both beginning and ending balances are listed. The flow of information from the original source documents through the financial statements is summarized in Figure 24%-6. Closing the books. The books are closed at the end of each year. This means that the final adjustments are made to update all accounts and then recorded in the general ledger. Then all income, cost, and expense accounts are closed out. Do this by reversing the balance in each account to leave a zero balance. This must be done at the close of each year to start the new year from scratch. Since all entries must have offsetting entries, the net amount of profit or loss must be entered in the retained earnings account. Profit increases this account and loss decreases it. On the balance sheet in Figure 24%-4, notice that the net worth section consists of two parts: retained earnings and net income. The net income part represents a year-to-date total, while retained earnings is the net sum of all previous year's net profits and losses. The following net worth accounts are commonly found in the general ledger itself: a capital stock accounts, partners' equity accounts, a partners' draw accounts, retained earnings, profit and loss. Figure 24-6 flow of information. Capital stock accounts change only when stockholders' investment balances change. Partners' equity accounts, or owners' equity accounts for sole proprietorships, receive their share of all profits, otherwise called retained earnings, at the close of each year. They are also reduced by the amount of draw each year: partners' equity plus profit, draw equal to adjusted equity. A retained earnings account, found exclusively on corporation books, is the sum of all prior years' profits and losses accumulated during the life of the corporation. A profit and loss account is used to isolate the current year's results. This account is closed out at year and into one of the other equity accounts described above. At the beginning of each new year, restore the reversal entries for accounts payable and accounts receivable so the general ledger again agrees with the actual totals in these accounts.